Welcome to the Explainer. So today, the market is absolutely celebrating. I mean, it's one of the biggest rallies we've seen in a long time. But we really need to dig into why that celebration might be, well, dangerously premature, and why a lot of professionals are looking at this exact rally as a potential trap.
Okay, so let's just dive right into it. On the one hand, you've got the market just surging on hopes of some big geopolitical resolution, and it looks fantastic, right? But on the other hand, the professional analysis, which is backed by some pretty serious data, is suggesting this is a classic bull trap. We're going to unpack that professional view step by step. First up, let's talk about these optimistic headlines. To really understand the trap, you have to understand the bait. What exactly was it that caused the market to just explode higher today? And I mean, the numbers really are impressive. We saw a huge surge pretty much everywhere you looked. The S&P 500 jumped nearly 3%, and the Nasdaq, which has been really struggling lately, just rocketed up almost 4%. That pulled it completely out of its recent correction. It was a total sea of green.
So the story driving all this seems pretty straightforward. We got these headlines that suggested there might be a diplomatic off-ramp in the whole Middle East conflict. And the market, well, it interpreted this as a huge risk-on signal that caused oil to sell off and all that money to just pile into stocks. It's a classic relief rally. But as any pro will tell you, the headline is almost never the full story.
Yeah, not quite. Because while all the headlines were screaming buy, 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 other parts of the market were telling a completely different story. If we just peek right beneath the surface, we start to find all this contradictory data that points to a much, much darker possibility, the signals of stagflation.
And this brings us to the really critical question. This is the one that separates a casual, surface-level view from a much deeper professional analysis. If everything is so great, then why are certain assets behaving in a way that suggests the exact opposite?
Okay, now this is what's so interesting. This slide shows things that just shouldn't be happening at the same time. You've got your risk-on assets like stocks totally soaring. But then you've also got your classic risk-off, safe haven assets like gold and silver soaring right alongside them. I mean, silver jumped over 7%. This is a huge flashing warning sign that the market is simultaneously hedging for stagflation, which is that really nasty mix of low growth and high inflation. So how in the world do we make sense of this contradiction? Well, to cut through all this noise, professionals turn to a key concept. It's something that helps them decide whether to trust the price action in stocks or the warning signs that are popping up everywhere else. It's called the IV primacy principle. And this principle is incredibly important. Basically, what it says is that when the VIX, that's Wall Street's fear gauge, is elevated, you should trust what it's telling you more than you trust the daily price of stocks. A high VIX means the smart money in the options market is paying up for protection because they see serious trouble on the horizon. And this just perfectly illustrates the point. Even with today's massive rally, the VIX is still closing above 25. Sure, it dropped over 17%, but the fact that it's still this high tells us that the options market is basically screaming that significant risk has not been resolved. The danger is still very, very much priced in. So what is it that's keeping the VIX so high? It's not just some vague fear. No, the market is staring down a gauntlet of really critical upcoming risks, and they're all concentrated in just the next few days. This is the timeline the market has to get through this week. You've got a deadline for a threatened attack by Iran, you have a crucial jobs report that could signal a really sharp economic slowdown, and then there's the final deadline for the Hormuz Strait. A negative outcome from any single one of these could instantly wipe out today's gains. And the most immediate threat is the one set for tomorrow, April 1st. Iran's Revolutionary Guard has issued a direct threat to attack the Middle East facilities of 18 U.S. companies. And look, this isn't some vague warning. The potential targets include some of the biggest and most important corporations in the entire world. So, given this really complex picture, a celebratory rally that's hiding some deep-seated risks, what's the takeaway? From a hedge fund manager's perspective, how should you be thinking about your portfolio right now?
This right here is the professional's checklist. Before you even think about adding significant new risk, these 4 conditions really have to be met. The VIX needs to drop below that key level of 20 and stay there, confirming that real fear is actually leaving the market. We need to see clear, diplomatic resolutions to these geopolitical deadlines. And the economic data needs to show us we're not about to fall off a cliff.
So, the really crucial point is this. The smart strategy right now isn't about chasing this rally. It's about patience and discipline. It means holding your core positions, but resisting that powerful urge to make any major changes until the massive uncertainties we just laid out on that checklist are actually resolved.
And that leaves us with a final, really powerful thought. It's so easy to have that gut emotional reaction to a big green day and just think, phew, the danger's past. But the data is telling a very different story. A VIX of 25 isn't a signal that the risk is gone. It's a signal that we've just stepped back from the absolute brink of panic. The question you should be asking isn't, is the crisis over? It's, what happens if one of those deadlines goes wrong?